Good afternoon, Size Traders. How's it going? Almost here with Gary, the head trader at SizeTrade. Gary, we spoke in the past of how every trader, whether he be long or short term, should be paying attention to corporate buybacks, and we had a lot of questions come in about it. So I wanted to see if you could clarify a few things for us. First, why are buybacks so important for the market short term, and why do you think this is a negative thing for the markets long term and a negative thing for the overall economy?
Hey Amos, how's it going? Buybacks is something I've been talking about for years now. I was kind of against them when they first started out. I thought it was a big deal. Now you see more of the mainstream media mention it. I still don't think they talk about it as much as they should,
When you say when
because
they first came out, what are you talking about? How many years are we looking
I,
at now?
I didn't mean when it first came out. When it first became on my bubble, when I first started noticing that corporations were increasing buybacks and it was becoming a earnings driver of EPS for them as opposed to organic growth, they were becoming more inclined to basically do buybacks versus use capital for research and development or other organic buybacks. Even, I mean, sorry, takeovers even. They felt it better use of money and easier use of money with low interest rates.
So how long is this trend going for?
After the crisis, well, we saw buybacks before the crisis, right before the crisis reached highs, and then
You're talking
after the crisis,
2008?
yeah, 2007, 2008, we saw them reach highs, and then after the crisis, obviously we saw slowdown in buybacks because it was hard to get cash. But then when everything kind of stabilized in 2010, this became one of the more preferred ways to get earnings per share growth for big corporations. And when you really saw it pick up is when activist investors started picking on companies with good balance sheets that could go out there and raise capital, and we're forcing these CEOs and companies to basically use their balance sheets to lever up and do buybacks and pay out dividends as well. I started looking at it in 2010, 2011 as a reason why the market could go higher and would continue to go higher. And I'll kind of talk about that in a second. And now I'm talking about it more of as a worry for long-term U.S. GDP growth rates. And I think that in the near term, as long as buybacks continue, it should make a nice floor for the overall markets. But we're getting to the end of it. We're getting to a point where the balance sheets of companies are too big. The amount of buybacks that they can do probably is going to slow down, especially if interest rates spike a little bit more here. We're at 2.5% on the 10-year. If it goes up to maybe 3.5, buybacks will slow down. Also, the balance sheets are getting so big that a lot of the investors are starting to look twice at it and asking if their AAA rating or whatever rating they have is a good rating considering they have so much debt on their balance sheets. To go back to how I started, this is something that I took a look at right after the crisis when it first started happening in 2010, and it was one of the main reasons I believe that the stock market had legs to go higher. In 2010, I don't know if it was 2010 or 2011, corporations became the biggest buyer of stocks out there, bigger than any other group, bigger than pension funds and so on, just from the mass amount of buybacks they were doing. The reason why companies do buybacks, let me start with that for some of our newer guys, is that when you retire shares, when you buy back the shares, your outstanding share count goes down. Earnings per share is calculated by your total earnings divided by total outstanding shares. So if you can grow your earnings, that's great. So let's take an example of 1 million shares outstanding and a company that earns $1 million every quarter. So you would take $1 million of earnings divided by 1 million shares, and you would get a earnings per share of $1 a share. Then you put some type of multiple on that company based on its growth rate, based on the industry it's in, based on overall economic conditions. Let's use an average PE ratio, which is the multiple we use, of 16, 17 times. So this company that earns $1 per quarter on a consistent basis over a year, which is $4 a year, would be then multiplied out by, let's take 15 just to make it easier, and it would be trading at $60 a share, or that would be the fair value of the company that analysts would consider. Now, if you can grow the earnings, that's great. So if you double your earnings and you get it to $2 million and you still have 1 million shares outstanding, you've grown your earnings per share from $1 to 2. So now instead of multiplying $4, which is the earnings for the year, times 15, you're multiplying $8 for the earnings per year times 15, and you're getting to 120. Is that sound right? Yeah, $120 a share. So by increasing your growth, your earnings out there, overall outstanding earnings, you've increased the share price by double, which took it from 60 to 120. Now that's the preferred way that the stock market works. That's the way that the market should work. As you grow your earnings, the price and value of your stock should get more expensive. Now, the other way to do it, which is financial engineering, a lot of people call it, is by decreasing the outstanding shares. So if you continue to earn $1 million in total earnings, but now instead of dividing it by 1 million shares outstanding, you're dividing it by, let's say, 500,000 shares because you were able to buy back half your float. So now you're earning $2 a share, but you didn't actually grow your earnings. So again, the stock could go to $120 a share without actual any real earnings growth out of the company. So the company didn't actually do anything better. It only bought back stock and lowered the amount of outstanding shares that are out there. Now, this is really common typically towards the end of a bull market when companies have, in the beginning stages of a bull market, the company has grown. We're coming out of a recession. All of a sudden, earnings are growing organically. Now it's in their interest to hire more workers, expand operations, spend a little bit of money on research and development to get more products out there, more exciting products, and so on. And that's how a proper economy should work. And then towards the end of the bull market, during the end of the bull cycle, you're going to start seeing a slowdown and a place where companies start taking over other companies to increase earnings by taking other out competitors. But also they begin to buy back stock because it's a very easy way to increase your earnings per share, which is what the stock market cares about and what investors care about. And investors at the end of the day are the boss of the CEO.
But let me ask you something, Gary. If you're saying that companies are able to artificially inflate their earnings per share, don't investors see this? Don't they see that what's going on? This is all public information. Why do they still buy the stock? Why do they still buy these companies if they know they are artificially being pumped?
Well, in the beginning, for short term, you get a big boost because, like I said, if you're earning $1 a share and now you cut that overall outstanding shares outstanding by half, you've increased your earnings per share to $2. Now, I'm not saying that that happens drastically. I'm just making a point here. They usually retire 10% of their stock. They do have some type of earnings growth, lackluster. So what ends up happening is you get 10% earnings growth, 7% of it which was due to cutting back outstanding shares, and 3% was organic growth. So this is good for short-term traders, and that's why activists love this, is because it actually increases the valuation of the company. It also, the other thing it does is it creates demand. The stock market is a marketplace where you have buyers and sellers, demand and supply. So if a company is buying back its stock, and we're talking about multi-billion-dollar buybacks over a few quarters, they're now buying a huge portion of the average daily volume. So they're creating a floor for the stock sometimes, where they tell their bankers, because they use bankers to buy back the stocks. So they tell the bankers, hey, I want to buy it anytime it goes under $75 if the stock is trading at 76, 77. So you create a floor. Sometimes they want to be a little bit more aggressive and say, hey, we want to buy it all the way up to 80. So now there's two positives to why the stock should go up. The first positive is because earnings per share are getting better. So based on the equivalent multiple that you had from the previous quarter, previous year, since now your earnings per share is growing higher, the stock will go higher. But secondarily, you have now a big buyer, huge amount of demand coming into the stock, but the supply of stock, the people who are selling the stock, is staying the same. There's no catalyst now to sell the stock other than the price is going a little bit higher. So for short-term traders, this is amazing. But I don't think in 2010, 2011, it wasn't talked about enough that this was one of the major catalysts to the overall stock market. Back then you had real organic growth also, but it was such a small portion of how much the stocks went up. The thing that nobody really talks about is why is it bad for the future. So we all kind of understand why it's good today. And there's actually a lot of people out there, there's strategies out there that just buy big buyback stocks because they think that they're going to outperform the market. because they have this floor under them because they're buying back stock, but also their earnings per share will go up higher than other companies. So there's companies out there that short stocks with smaller buybacks or without the capabilities of buyback because they have bad balance sheets or too much debt, bad ratings or too much debt on their sheets, so they can't go out and realistically do it. And they buy better quality companies that are doing buybacks, and the bigger the buyback, the more they want to own it. There's other strategies out there, which is more of an activist strategy, which is finding companies with good balance sheets and buying them that are not doing massive buybacks or massive dividends, and hoping or anticipating that an activist like a Carl Icahn, Bill Ackman will come into the company, buy a decent share of the company, and then pressure the CEO to buy back the stock. So you kind of have a lot of strategies based on the buybacks, especially with big hedge funds use these strategies and so on. Now the mainstream media has been talking about it a bit more. I wrote an article about it actually a little while ago, but I still think that people are underestimating how important buybacks are for the market, and also how important it is to keep an eye on interest rates, because as interest rates go up higher, it becomes more expensive to do these buybacks. So this is kind of what we're looking at right now. It's an interesting concept here with interest rates going up because they're expecting future growth from a pro-business government. You're going to start seeing a little bit of a negatives coming into the market. And one of those things that nobody's talking about right now is that as interest rates go up, because they're still relatively low, buybacks are going to get more expensive to do, and companies might think twice about it. Now, that's all short term, and that's one of the things that you should take a look at, especially if you're investing in a company and you want to get kind of more bang for your buck. You find the companies that have authorized the most amount of buybacks. I think almost every single company in the S&P 500 has some type of buyback. Even Apple, IBM had a huge buyback. So I would look to companies that have good balance sheets and have the ability to sustain the big buybacks, but also make sure that they're focused on it, as opposed to companies that are not. And it's much harder right now to have organic growth when the GDP is around 1.5–2%. And as interest rates go higher, it will be probably smarter to back out of companies that have gotten a lot of their growth from buybacks, and maybe find companies that are better fundamentally, that haven't used buybacks as much and are genuinely growing in this type of environment.
So, Gary, tell me, where do you see the negatives long term?
So the long-term negatives, I think, outweigh the short-term positives, in my opinion. As a person who wants to see long-term growth and not looking at short-term benefits in the stock market, what you're doing is typically, like I said, the typical cycle was in the beginning you have organic growth because the economy is expanding after a recession. Companies are using cash, they're borrowing cash and using that cash to pay for positive things that are going to increase their competitiveness, updating capital infrastructure, buying factories, buying robots, hiring people, and so on. Also, research and development for companies that need that. And then as you get closer to the end of this business cycle and companies are looking for growth in other places and they can't find it organically, they obviously slow down the building, they slow down the capital investments, and then they look into financial engineering. And financial engineering has typically only lasted the last 2–3 years of a bull market in a big sense. Obviously, there's buybacks all times, but in a big sense where that's the majority of how you grow your earnings, has usually only lasts 1 or 2 years before you see some type of recession. Now, when you do see the recession, you need a good balance sheet typically to withstand the recession. The deeper the recession, the better you need, the more cash you need on hand you need, the better balance sheet, so you're able to go get cash out there you need. And by doing these massive buybacks and destroying balance sheets, even at lower rates, and it makes sense to do buybacks when rates are 1, 2, 3%, when you can borrow at those type of rates long term. But what ends up happening is every company, when there is a recession, needs to hold back on cash, hold back on buybacks, but also needs to access bond markets, capital markets, and get cash so that they're not necessarily having to downsize as much as they probably should, because they're able to borrow the money, use that capital to stay afloat, withstand the recession, come out of the recession maybe even stronger as competitors who had bad balance sheets go out of business, and again start growing from there as the economy rebounds. When you have such huge balance sheets like some of these companies do now, I'm not quite sure how many of these companies will be able to withstand a higher interest rate environment where investors don't feel confident buying 30-year paper from IBM or whoever it is at 2 3%. So what will happen is these companies will have a much harder time when their balance sheets are degraded so much, raising capital at decent interest rates, kind of like what happened to Greece, but on a corporate level, right?
If I could make the analogy, Gary, it sounds almost like QE on a corporate level. Would that be accurate? It sounds like something similar that China does with its stock market, for instance, by just buying it.
Yeah, I mean, I think QE. This happened because of QE. I think this is one of the things that QE wanted. The Federal Reserve's idea was if we make it cheap for companies to borrow money and not keep cash on their balance sheet, so let them earn 0%, companies will borrow a ton of money. But the secondary idea that never came across was that once they borrow that money, they need to put it someplace because interest rates are low, and they thought they would put it back into their business, hire people, buy computers, build factories, and all of this was supposed to spur investment in the U.S. in the world, and also push up inflation, as well as create jobs and just make the recovery a lot smoother. Now that never the first part came true. They borrowed a ton of money. The second part never came true because the companies never believed in the recovery. So what they did was they just bought back stock. They used that money to buy back stock. The ones that didn't borrow money got their arms twisted by activists. So they were forced to buy back stock anyway. So what ended up happening is that money kind of burnt away. It's a very inefficient. I'm not saying all buybacks are bad, but it's not the most efficient way to get the money to the government. It's a good way to get money back to shareholders. But unfortunately, only a small percentage of Americans or worldwide own stocks. So they benefited from that. And then that benefit, when you're holding a stock in IRA like most Americans do, they don't sell it and use that cash because they can't. So what ends up happening is they get appreciation in the IRA, which they might use in 20 or 30 years, but it doesn't matter today because as the stock goes up today and then crashes in 10 years, and by the time you take out your IRA in 20 years, it's at a different level anyway. So you're not getting that benefit from that. So the people who got benefit are the people who have who own stocks, but not in the IRA. And that's a very small portion of Americans. That's typically, they say the top 1%, but, there's probably 10, 20% of wealthy Americans that have a significant holdings in stocks. And they benefited. And that goes down to the core of income inequality and stuff like that, because as assets went up, the people who owned those assets, like real estate and stocks, benefited much more than the ones who didn't own assets or owned very few assets, which was the average middle class worker. So getting back to why it's negative is that when you've degraded your balance sheet, when there is going to be a recession or a pullback in the economy, these companies are now going to be less able to take on debt and manage the recession. The other problem is that at some point you have to pay back the principal. So when interest rates are very low, that's great because you take it out and you pay a small interest rate of 1, 2, 3% depending on the company when it took it out. But at some point, and typically these companies took out 10 to 30 years. They were smart. They took out long-term paper. At some point, you have to pay back that principal on that paper. When you pay back the principal on that paper, you have to pay current market rates. Right now, we are at historically low interest rates. In 15, 20, 30 years, interest rates could be 8%, 10%, 5%. And now you're talking about a huge, huge burden on companies who have to refinance that paper from, let's say, 3% to, let's say, 6%. They're going to be now forced to pay back double monthly what they're paying now, if they're able to even get it.
So not to be too doomsday about this, but I mean this seems like a really dire situation for corporate America, for all companies almost, since most of them have participated in these corporate buybacks. I mean, what's going to be the fate here? How are they going to deal with this?
It's a good question. I see this as a similar problem to the housing market. 8 years ago, 10 years ago, you had, back then it was slightly different. People were using the home equity in their houses to pay for things such as cars and vacations. And when the housing market crashed, they were basically holding a much more expensive house than what they bought it for because they refinanced and took money out of it. And it was also worth a lot more than the current market rate, and they just walked away from it. I see some of the benefits is if you borrow today and you have to pay back in 30 years, hopefully you're going to grow earnings enough to pay back the principal. The problem is you're actually stealing from the future. So as you pull forward all of this spending, pull forward all of this borrowing, and you're not using for spending, then nobody's buying your products as well. So IBM is doing massive buybacks. That's great, but they're not buying other people's products. Same way that if when Apple does a buyback, instead of investing in buying Netflix or doing something else that people think would be positive for their business, maybe spending more money on research and development and so on, they're buying back stock. They're now taking away from other companies that would have supplied to Apple. So what you're doing is you're stealing future growth rate by pulling it forward. So stocks will appreciate because, as I said, the EPS goes up. But long term, it's not really great for any one company because you're not buying any products, right? So if IBM would use, instead of buying back so much stock, they would have borrowed money and said, hey, we want to get into another industry. We want to really get into the cloud. So now we have to hire 20 of the top people in the US who know cloud. We need 100 engineers to build the cloud behind it. So now you hired 120 people. You rented a space because you need more space. You've bought more computers now because each person needs a computer. You bought software packages from Salesforce and so on. So now you've stimulated, so you've used $1 billion and you've stimulated into building a building or renting a floor. You created 120 jobs. You bought desks, you bought chairs, you have carpets, you paid an architect to build it out. You paid Microsoft for Windows, you paid Hewlett Packard for computers, and so on and so on and so on. And that $1 billion gets trickled down, gets split up. Some of it goes down to the wages, so people feel better. It also pushes up wages of other people because now there's less people looking for jobs. Those people spend money on computers and IBM products and so on. So every company, that's kind of how capitalism should work. So that IBM does that and helps out Cisco with routers and so on. And then when Cisco now needs to hire more people because IBM is doing it, instead of putting money into buybacks, they put their $300 million into outfitting another office. And now they're buying IBM cloud servers and so on and so on. And that's kind of how like the avalanche goes. It feeds off of each other. So when you use that money for buybacks, once you burn that money into buybacks, you can no longer borrow that money back. So as IBM's balance sheet, yes, they can borrow more money, but IBM's balance sheet goes up and up and up and up and up, and interest rates go up and up and up and up at some point. They're not going to be, it's going to be much more difficult for them to borrow more money because people out there are going to say, hey, they've borrowed a lot of money. They've been making payments on this low interest payment, but the sum is so big that it adds up. And now they want to borrow more money, but now the interest rates are 5% instead of 3%. And we don't know if they can handle it. That it's just too much based on what they're currently earning. That might be just too much. We either need to get paid a lot more for the risk. It's exactly what happened in Greece. Greece was after Greece joined the EU, its interest coupon rate dropped dramatically because it was seen as more trustworthy. And instead of continuing to borrow, let's say $100 billion a year, but it cut their interest payment in half because the interest rate went down in half, they decided to just borrow more. They doubled the borrowing.
So Gary, I know you don't have a crystal ball, and nobody has a crystal ball. Nobody can tell the future what's going to happen. But what do you think? How do you think short-term investors and how do you think now long-term investors should tackle this problem? Just to get back to the original question.
Well, I think in the near term, you're better off buying companies right now as this continues. Even though I think we're getting towards the end of this buyback, I think you'll continue to see companies with bigger buybacks are going to do better. They're going to do better. Now, for the short term, that's great for investment, and if you're able to move in and out of stocks pretty quickly, that's a good idea to buy these companies with the buybacks. But long term, these companies will probably underperform other companies that have better balance sheets. So if you're not nimble and you need to buy a company, then you have to kind of find a good median, a company that's doing some sort of buybacks that are going to help their earnings growth in the near term, but also a company that is not degrading its balance sheet to a point where it's going to have a difficult job competing with Chinese competitors, European competitors who don't do these type of tricks or do it on a smaller scale. Saying that, there's a lot of companies that do have great growth rates or potential for growth rate. Like, Amazon is exploding. It doesn't have a great growth rate. It has a huge PE, but they're not relying on buybacks. Tesla not relying on these companies have done really well. Facebook not relying on buybacks. They've had real organic growth. The problem is that right now organic growth is very expensive. So Amazon is trading at 80 times earnings, 80 PE. Facebook is high. I don't know exactly. It's getting cheaper because they're growing earnings so fast. Um, Tesla doesn't have earnings. It's losing money. So these companies are based on historical ideas of what's expensive or expensive. So, there's a lot of places to put your money. You have to be cognizant of why earnings are going up. And if you can find a company that has organic earnings growth, like Facebook, you're going to get paid a lot more right now for it. Like the price of the stock will go higher and it's better quality earnings. And if you're a long-term holder, you have to also be cognizant of it because if you're holding stock for 10, 15, 20, 30 years until you retire, do you really want to be long a stock that it's short term going to explode higher, but long term is going to not have the ability to compete when it does need to raise money, either to make it through a recession or maybe just to even compete from the aspect of upgrading its infrastructure, upgrading its research and development, and so on, because the Chinese companies are, European companies are, and it seems to me right now that American companies, due to this financial engineering, are kind of losing their competitive edge a bit. So if you're long-term minded, you got to take that into account and see where's that earnings growth coming. Is it coming purely from buybacks? Is that their main strategy? And if it is, I'd be wary. Not maybe in the next 6 months, 1 year, but over the next 5, 10 years, I'd be very wary of companies that are doing tons of financial engineering to grow their stock price.
Gary, a lot of interesting things here you said today. Thank you so much for your time. We'll stay tuned, and as always, Size Traders, subscribe. We'll keep you updated. And until next time, this is Amos with Gary, head trader.